So as you look at unadjusted and adjusted balances for Everett Company, you should find differences. Do you have pre-numbered? Are they pre-numbered? Yes. Count them up. How many do you see? 7. So 14 of them should technically be different as unadjusted becomes adjusted. Some of them are going to go up in value. Some of them are going to go down in value. Should we just start? It appears they're going to have us do them in order of change. Now, one thing you could do, now on the test, you can like cross things off as you're done with them. You could put little check marks. If you want to lightly check as you go, does that make sense? So like look at AR. It started at 10,400. It increased to 11,005. If you want to put a tiny little light check mark by that, you could, because then we're going to go find a little partner down at the bottom. And by the end, you should have 14 check marks. Does that make sense? If you would like to do that just for your clarifying, you can. So if AR increased by $1,100, what does that mean? We must have sold something, right? Cash didn't increase, AR did. So this is an accrual that payment is being postponed till a later date. Now, if I go down to revenue, have we seen an increase of $1,100 as well? Ding, 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 ding. We've got our first adjusting entry. So you could also check off service revenue. AR went up, service revenue went up by $1,100. Remember, these adjusting entries are either accrual or deferral. Either money's there or the event is not, or the event is there and money is not. In this case, it's an accrual because we are not waiting for the money. The event happened, the money will follow later. So remember, deferrals, the money is there, event is later. Accruals is the event is there, money is later. And remember, we always have to have one from the balance sheet and one from the income statement. If it would help you, and I apologize about not having this in printed format, I'm going to do something once. If this little line with a pencil would help you, you could, with a pencil in your book, draw a line under owner's drawing above service revenue. I know, right? Draw a straight line. If that act of drawing a line helps you, just remember, every adjusting entry, something's got to come from above the line and below the line, because above the line is balance sheet, below the line is income statement. That certainly helps me when I'm doing this, and I'm the teacher, so I would assume it would help you. All right, 1 done, 6 to go. You should have 2 accounts check marked because you did 2 of them. You have 12 more to go. Next one, supplies. Why did supplies shrink by so much? Started at 1,500. Yeah, I'm looking at it correctly. And why did it shrivel down to 650? What does that mean? We used them. So if we used an asset, are we going to debit or credit it? Credit, because if we debited it, that means we gained, and we did not gain supplies. Okay, so we've got a balance sheet account credited. That's from above the line. What does the other one have to come from? Below the line or income statement. Well, if we use supplies, what's the expense called? Supplies, oh, was it doing rent? Shame on them. Can we go down and do supplies? We'll come back to the rent one. why is it 850? Well, 1,500 minus 650 is 850. I would do that math if I were you, but then all of a sudden you cruise down to supplies expense and it started at 0 and it increased to 850, and it's a really nice way to double check your math. Would you agree? I'm using sticky notes so I can see straight. I see some of you using pieces of paper. It's really annoying otherwise. This is a deferral because we're deferring use of our supplies, but we prepay for them. We pay for our supplies and we defer the event of using them. Now let's do rent expense. I'm not sure why my answer key didn't go in that order, but whatever. Rent, prepaid rent, kind of like prepaid insurance. We own it. It started at $2,200. It went down to $1,200. How much did we use? $1,000. Well, as we use what we prepaid for rent, like we maybe rent from someone. We're not a rental agency. We are renting, maybe an apartment, an office building, whatever. As we use it, kind of like supplies, we expense out what we use, and prepaid rent, that asset, goes down. Prepaid rent was from the balance sheet. Rent expense was from below the line or the income statement. And maybe this simple idea of drawing a line and pulling something from the top and something from the bottom, that was your light bulb. That's all you needed. It does make it a little bit easier, doesn't it? If we prepay for rent, meaning we've prepaid an event that's going to be deferred over time, that's considered a deferral. Out of 7 entries, we already got 3 done. That's pretty good. I'm just going to peek and see what they try to make us do next. Equipment, 18 grand. I'm still driving around my little beep, beep, beep delivery truck. However, what grew? Accumulated depreciation grew. Why do I see that as a credit though? I thought all assets were debits. It's offsetting the value of what? Our delivery truck or whatever it is for equipment. So we see accumulated depreciation grow by $700. That's an asset, sort of. It's a contra asset. So if I took something from balance sheet, where does the other side of it have to come from? Income statement, and it's called depreciation expense. I've been doing this the whole time with you, but this is not equipment as the credit. We are not like kicking off one of the tires and saying, good luck driving that thing. We still need the equipment at its purchased value. It's just that we have this pile growing that will offset the value. Where did I come up with $700? Because it was 0 and it grew to 700. Notes payable stays the same. AP stays the same. What happened with salaries and wages payable? Why do all of a sudden I owe my employees? I should go back to this one, sorry. Let's go back to depreciation expense. Is it a deferral or an accrual? It's kind of like prepaid all of this. We have our equipment. It's prepaid for. The money was there. So this is a deferral because we're deferring use of it. Okay. I got a little ahead of myself there. We owe employees. They were working at the time of when? The switch of the fiscal period. Okay, so we have to say that they worked in the correct year, and then we're just going to pay them for it later. It doesn't make sense with like 3 days left in our fiscal period to hurry up and make the payroll people just get their books done too. Oftentimes payroll spans more than one fiscal period. It's very common. So if we owe our employees how much? $725. Something's coming from the top of the line. What's going to be from the bottom of the line? Salaries and wages expense of $700. No, 100? Why did they go out of order? Boy, oh boy, they're really out of order. Shame on them. There it is at the way bottom. So never mind this middle stuff here. Okay. I went a little, I don't like that it's out of order, so I'm going to cover that up again. Interest payable. The word payable says I owe somebody, right? When do I owe interest? On a, starts with an L. On a liability. A long-term one, like a school loan or a house loan or a car loan. So likely what happened is knock, 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 bank, I need some money. They gave it to me. And we're going to defer use of that money. But when the fiscal period ends, we have to say how much money has built up on what I owe on the principal, in other words, interest. So interest payable started at 0, increased to 100. That's from above the line. What are we going to use from below the line to expense out what happened? Interest expense. This is a deferral because I think it's a deferral because they give us the, or is it an accrual? You guys are, no, you're right, it's accrual. The event is happening, we're going to pay what we owe on that later. Back to the salaries one, I always forget to write those down. That was an accrual as well. Our employees worked, we're going to pay them later. Are we down to just one left? Wow. Unearned rent revenue. It's a liability. Because someone must prepay for rent. And as the months go by and we provide a place to be rented, we do part of our work. Just like when you prepay your dentist bill and every time they do work, it chips away. Well, hopefully not literally chips away at a dentist, but you get the idea. So unearned rent revenue, as we perform that owed liability and it's reduced, it turns into earned revenue. So unearned turns into earned. So you will see unearned rent revenue go down. The liability will be decreased. That's above the line. So then we'll use below the line income statement as rent revenue. We turn unearned, what we owed, into earned that we fulfilled. And the difference was $850. Accrual or deferral? Was the money there and then we did the work? Talk about perfect timing. It would be wise of you to do the same version for the B set. So 3, 3B, do the adjusting entries. When you walk in tomorrow, then we can double check that you did them correctly. What's going to be awesome is during class then tomorrow, we'll do 3 financial statements, your only homework tomorrow night will be your practice test. Awesome news. Thanks for being awesome.